Welcome to Financial Habits. In this video we are going to talk about IRA versus IRA Roth. So before starting this video, like this video, and subscribe to Financial Habits for future updates. Individual retirement accounts, IRAs, are tax-advantaged vehicles for long-term savings and investing, with the goal of accumulating a nest egg for retirement. While some IRAs are offered through the workplace, the two most popular are the regular IRA, which was formed in 1974, and its younger cousin, the Roth IRA, which was introduced in 1997, and named after its proponent, Senator William Roth. While these accounts have certain commonalities, they also have some major differences, most notably in terms of tax deductions. Do you want to owe the IRS now or later? Money accessibility and eligibility requirements. It's critical to understand all of the differences before determining whether IRA is the best fit for you. The main distinction between a Roth and a standard IRA is the timing of the tax benefits. Traditional IRA contributions are tax deductible now, but withdrawals are taxed later. Roth IRA contributions are taxed now, but withdrawals are tax-free afterwards. Traditional IRAs work similarly to personalized pensions in that they limit and regulate access to money in exchange for significant tax benefits. Roth IRAs are similar to ordinary investment accounts, but with the added bonus of tax benefits. They have less limits but also lesser tax breaks. Which IRA to choose depends on whether you believe your annual income and tax band will be lower or higher in retirement. Tax breaks are a major distinction. Traditional and Roth IRAs both offer substantial tax benefits. However, when it comes to claiming them, it's all a matter of timing. Traditional IRA contributions are deductible on both state and federal tax returns in the year they are made. As a result, when you make withdrawals, officially known as distributions, they are taxed at your current income tax rate. Traditional IRA contributions reduce your taxable income in the year you make them. This reduces your adjusted gross income, AGI, potentially allowing you to qualify for other tax benefits you wouldn't otherwise be eligible for, such as the child tax credit or the interest deduction on student loans. Because you don't get a tax deduction when you contribute to a Roth IRA, they don't reduce your adjusted gross income for the year. As a result, your retirement withdrawals are usually tax-free. You paid your tax payment in full up front, so you owe nothing on the back end. To put it another way, it's the polar opposite of a regular IRA. Both a Roth and a regular IRA can be owned and funded, provided you're eligible for both, but your total contributions in all accounts must not exceed the overall IRA contribution maximum for the tax year. Income limits are a major distinction. A traditional IRA is open to everyone with a source of income. Your income and whether you, or your spouse, if you're married, are covered by an employer-sponsored retirement plan, such as a 401k, determine whether your contribution is fully tax-deductible, K. In 2020, singles must have a MAGI of less than $139,000, with contributions tapered out starting at a MAGI of $124,000. Roth IRAs, on the other hand, have income restrictions. For 2020, singles must have a MAGI of less than $139,000, with contributions phased out starting at a MAGI of $124,000. To contribute to a Roth, married couples must have adjusted AGIS of less than $206,000, and contributions begin to taper down at $196,000. Singles must have a MAGI of less than $140,000 by 2021. With contributions phased off beginning at $125,000. To contribute to a Roth, married couples must have adjusted AGIS of less than $208,000, and contributions begin to taper down at $198,000. Distribution rules are a major distinction. Withdrawals are another distinction between standard and Roth IRAs. Traditional IRAs compel you to begin taking required minimum distributions, RMDs, mandatory taxable withdrawals of a proportion of your funds, at the age of 72, regardless of whether or not you need the money. The IRS provides worksheets to help you calculate your annual RMD, which is dependent on your age and account size. There are no required minimum distributions in a Roth IRA, so you don't have to take any money out at any age, or even at all during your lifetime. They are good wealth transfer vehicles because of this attribute. Beneficiaries of Roth IRAs are also exempt from paying income taxes on withdrawals, though they must take distributions or roll the account into their own IRA. Pre-retirement withdrawals are a key distinction. If you take money out of a traditional IRA before the age of 5,912, you'll have to pay taxes and a 10% early withdrawal penalty. 9. If you use the money to pay for qualified first-time home buyer expenses, up to $10,000, or qualified higher education expenses, you can avoid the penalty, but not the taxes. Permanent disability and certain amounts of unreimbursed medical expenses may be exempt from the penalty, but the payout will still be taxed. 9. You can, on the other hand, take out amounts equal to your Roth IRA contributions, penalty and tax-free at any time, for any reason, even before you reach the age of 5,912. You can withdraw your earnings if you want to. If you withdraw earnings from a Roth account, amounts more than the amount you contributed, new rules apply. Normally, you'd be penalized for those. If you've owned a Roth IRA for at least 5 years, and at least one of the following criteria applies to you, you can avoid taxes and the 10% early withdrawal penalty by withdrawing earnings. You must be at least 59.5 years old. Have a permanent impairment. When you pass away, your beneficiary or estate receives the funds. Use the funds for a first-time home purchase, up to a $10,000 lifetime maximum. Additional benefits. Up to $10,000 in earnings can be withdrawn penalty-free, after 5 years to cover first-time home buyer costs. Before the age limit and the 5-year waiting period, qualified education and hardship withdrawals may be available without penalty. Withdraw up to $10,000 without penalty to cover first-time home buyer costs. There are also qualified education and hardship withdrawals available. Roth and traditional IRAs have different considerations. When picking between a regular and a Roth IRA, one of the most important factors to consider is how your future income, and, by implication, your income tax bracket, will compare to your current circumstances. In effect, you must decide whether the tax rate you pay today on Roth IRA contributions will be more or lower than the rate you pay later on traditional IRA payouts. Although it is common knowledge that gross income drops in retirement, taxable income does not always. Consider that for a moment. You'll be receiving, and maybe owing taxes on, Social Security benefits, as well as perhaps having investment income. You could perform some consulting or freelance work, but you'll have to pay self-employment tax on it. When the children have grown up and you cease contributing to your retirement fund, you will lose several useful tax deductions and credits. Even if you stop working full-time, all of this could result in a greater taxed income. In general, a Roth IRA may be the preferable option, if you expect to be in a higher tax band when you retire. You'll pay lesser taxes now and remove funds tax-free, when you're older and in a higher tax bracket. A regular IRA may make the most financial sense, if you plan to be in a lower tax bracket during retirement. You'll profit from tax advantages now, while you're in the higher bracket, and pay lesser taxes later. Final thoughts. In terms of administration, the two forms of IRAs are identical. Most brokerages serve as custodians for both Roth and traditional IRAs, which have the same minimums, costs, and periods. What do you think about this video? Do let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.